Hello everyone, I'm Kartika. Welcome back to Let's Learn. So if you are new to this channel, please subscribe the channel for more commerce videos and also click the bell icon to get the latest notification. So today's video is all about international capital market instrument. Okay, so what is international capital market? What is international finance market? All these were explained in the previous video. So if you have not seen that video, please go and watch it. The link is given in the description box. Okay, so now let's discuss the international capital market instrument. So international capital market instruments can be classified into three as international bond, deposit receipt and international equities. So under international bond comes foreign bond, euro bond, FRN and other bonds. And under deposit receipt comes ADR, that is American deposit receipt, and GDR, that is global deposit receipt. Okay. So international capital market instrument is classified into three as international bond, deposit receipt and international equities. Okay. So let's first see the international bond. So what is an international bond? As it is a bond, we all know that it is a debt instrument. So these are debt instruments issued by international agencies, government and companies for borrowing foreign currency for a specified period. Okay. So this international bond can be classified into foreign bond, euro bond, FRN and there are other bond also. So what is a foreign bond? So foreign bonds are long-term debt instruments which are issued by firms and government outside the issuer's home country. That is, we can take the example of a Yankee bond. Yankee bond is a foreign bond but is issued in US and is denominated in US dollars. Okay. Then comes Bulldog bond. Bulldog bond are foreign bond which are issued in United Kingdom, that is UK. Samurai bond are also foreign bond which are issued in Japan. Okay. Then comes Bunny bond. This Bunny bond helps the investors to reinvest the interest amount into other bond. Okay, that is a Bunny bond. Okay. Then comes a dragon. So dragon bonds are issued in currencies like dollars, yen and other currencies to attract the Asian investors. Okay. Then comes the zero coupon bond. Okay. Zero coupon bonds are bonds which are sold at a discounted value than the face value and it is redeemed at a face value. Such bonds are known as zero coupon bond. So all these bonds comes under the foreign bond. So foreign bond is a long-term debt instrument which is issued by firms and government outside the issuer's home country. Okay. Then comes Eurobond. So Eurobond is also a long-term bond which is issued and sold outside the country of the currency in which they are denominated. Okay. Suppose dollar denominated bonds are issued in Europe or Asia. Okay. That is, Eurobond are bond which are sold outside the country of the currency in which they are denominated. Suppose they are denominated in dollars, US dollars, they will be sold in countries like Europe or Asia. Such bonds are known as Eurobond. Okay. Now let's see the main difference between foreign bond and Eurobond. Okay. So foreign bond, the issuer select a foreign financial market where the bonds are issued in currency of that country. But in case of Eurobond, as we studied, are denominated in a currency other than the currency of their own country where the bonds are issued. Suppose it is a US dollar denominated bond, it will be issued in countries other than US. Okay, so that is a Euro bond. Then foreign bond, these are normally underwritten by the underwriters of the country where they are issued, and Euro bonds, these are underwritten by the underwriters of multinationality. Foreign bonds, the maturity is determined keeping in mind the investors of a particular country where it is issued. Okay, so the maturity will be determined in the country in which the foreign bond is issued. Okay, but in Euro bond are tailored to the needs of the multinational investors. Then in foreign bond, these are normally subjected to governmental regulation in the country where they are issued. Suppose it is issued in US, then the governmental regulations of the US is applicable on this foreign bond. But in case of Euro bonds are free from these rules and regulations of the country where they are issued. Okay, so these are the main differences between foreign bonds and Euro bonds. I hope it's clear to you all. Now let's move on to the next. Next one is FRN, that is floating rate note. Okay, This is also a type of capital market instrument, international capital market instrument. Okay, so it comes under the international bond. So it is a medium term euro bond. Okay, so we learned what is a euro bond just now. So Eurobonds are bonds which are sold outside the country in which the currency is denominated in. So floating rate notes are its medium term of Eurobond, and the rate of interest varies in line with the LIBOR. Okay. So LIBOR is London Interbank offered rate. So these floating rate notes are the interest rate will be varying with the variation in the LIBOR rate. Okay. So these are usually specify a minimum rate payable, which is known as a coupon rate. Okay. So FRN have a variable interest rate provision that adjusts the coupon rate according to the prevailing market rate. So floating rates can be taken as a medium term euro bond which have a interest rate which is varying, that is a floating rate of interest, and the rate of interest will be varying with the rate in the market, that is the rate in LIBOR, and LIBOR is London Interbank offered rate. Okay, so that is about floating rate note. Okay, now let's see the other bond. So our first one is a global bond. Okay, so what is a global bond? World Bank issued the global bond for the first time in 1989 and 1990. Since 1992, such bonds were issued by companies also. So till 1990, these global bonds were issued by World Bank. But since 1992, these global bonds were issued by companies also. So it is a very large international bond offering by a single borrower that is simultaneously sold in North America, Europe and Asia. So these bonds are simultaneously sold in different countries, that is like North America, Europe and Asia. Okay. Presently, there are 7 currencies in which global bond are denominated. So this global bond is a large international bond which are sold in different countries, and currently these global bond have 7 currencies denominated. Okay, that is Australian dollar, Canadian dollar, Japanese yen, Swedish krona, euro, American dollar and UK bond. So these are some 7 currencies in which global bonds are denominated. Okay, so as these are very large international bonds, they carry high interest rate, and these are sold simultaneously in different countries and are also traded on home market. Okay, so that is all about global bond. Now the next one is a straight fixed rate bond. Okay, so what is a straight fixed rate bond? As the name suggests, it have a fixed rate of interest. Okay, that is the rate interest rate is fixed and it is known as coupon rate. Okay, so it is a fixed with reference to the rate on treasury bond for comparable maturity. So the bond which have a fixed rate of maturity, a fixed rate of interest is known as a straight fixed rate bond. Then comes euro medium term bond. These are fixed notes issued by a corporation with maturity ranging from more than a year to about 10 years. Okay, so these are medium term notes. Medium term notes, the maturity is ranging from 1 year to 10 years. The diversity and flexibility of euro medium term notes offer are the two of the main benefits. So what are the main benefits of euro medium term notes? First one is diversity, second one is flexibility. Okay, another benefit of euro medium term loan is that it benefits in savings. So these are the benefits of euro medium term notes. Okay, next comes the convertible bond. Okay, these are bonds which are convertible into equity shares or depository receipt after a specified period. Okay, so when we buy this convertible bond after a specified time period, we can convert it into either equity or to depository receipt. Okay, so because of this facility, these bonds carry a lower rate of interest than the rate on any other similar non-convertible bond. Okay, so usually now convertible bond will have a lesser rate of interest compared to other bond because these can be converted into equity or into deposit receipt after a certain period of time. Okay, so these are the bearer security with no registration of owners. So we can say these are unsecured bond. Okay, these bonds are listed or traded on one or more stock exchanges abroad. Until conversion, the issuer has to pay the interest on convertible bond in dollar or in some other foreign currency. If the conversion option is not exercised, the redemption also has to be done in foreign currency. Okay, that is till the time period of conversion, that is after, till time period it is converted into equity or deposit receipt, the interest will be paid to the holder in foreign currency or in dollar. Okay, suppose I have a convertible bond and till I'm redeeming it, the interest will be paid to me in dollars or in foreign currency. Okay, and if I am not opting for conversion, that is I'm not ready to convert my bond to an equity or to a deposit receipt, then that bond will get redeemed. Okay, so it can be redeemed in a face value, that also will be done in a foreign currency. Okay, so convertible bonds are bonds which can be converted into equity shares or depository receipt for after a specific period of time. Next comes dual currency bond. Okay, so these are straight fixed rate bond issued in one currency, say Swiss franc, that pay coupon interest in same currency. It only if it worked to its benefit. The above benefit reason for their popularity. At maturity, the principal amount is repaid in another currency, say US dollar. So, dual currency bond are bonds which are bond with a fixed rate of interest, and the rate of interest will be paid in one currency, but at the time of redemption the principal amount will be paid in another currency. Okay, suppose I have a bond which is issued in Swiss francs, and at the time of maturity the principal amount will be repaid to me in US dollars. Okay, till the interest paid to me till the redemption period will be in one currency, and the principal amount will be paid to me in another currency. So it has a dual currency, so that is why it is known as dual currency bond. Okay, and this dual currency bond became popular in the mid 1980s. Okay, next comes cocktail bond. So what is a cocktail bond? These are bond denominated in mixture of currency. Okay, that is there will be more than one currencies. The SOR bonds represent a weighted average of 5 currency. Okay, that is minimum they have a 5 currencies in them. The investors purchasing the cocktail bond get automatically the benefit of currency diversification, and the foreign exchange risk on account of depreciation of one currency is offset by appreciation of another currency. So the main benefit of a cocktail bond is that it is a mixture of five more currencies. So if one currency, the value of one currency goes down, it get balanced because the value of another currency goes up. Okay, so the depreciation of one currency will be offset by the appreciation of another currency. So cocktail bonds are bonds which denominate in mixture of currencies. Okay, so next comes a BRADY bond. Okay, so what is a BRADY bond? These are bonds which are created at the time of mid 1980s through IMF and central bank sponsored programs under which US and other banks exchange their dollar loans to emerging market countries for dollar bonds issued by the relevant countries. That is example Philippines, Mexico, Brazil, etc. Okay. These bonds had a much longer maturity than that promised on the original loans and lower promised original coupon than the interest rate on the original loan. Okay, so BRADY bonds was introduced in the mid 1980s through IMF and central bank sponsored programs. Okay, under which US and other banks exchange their dollar loan to emerging market countries for dollar bond. Okay. Next comes is a sovereign bond. So what is a sovereign bond? Recently, as the credit quality of some less developed countries has improved, some BRADY bonds have been converted back into sovereign bond. So what is a sovereign bond? Sovereign bond are bonds that are swapped for an outstanding loan to a less developed countries, in which the US Treasury collateral backing is removed and the creditworthiness of the country is substituted instead. Okay, so the last type of international bond is ALPINE convertibles. So what is the ALPINE convertibles? This is a new alternative for the companies which are looking for overseas fund. These ALPINEs are making an entry into the country through three major Swiss bank, Union Bank of Switzerland, Credit Suisse and Swiss Banking Corporation. Okay. So ALPINE convertibles are making entry to the country through three major Swiss banks, that is Union Bank of Switzerland, Credit Suisse and Swiss Bank Corporation. These ALPINEs are convertible bonds sold to the Swiss investors through Swiss banking syndicates, and these are issued in dollars and sold only through Swiss retail investors network. Okay. So these ALPINE bond are sold to Swiss investors at denominated in US dollars, and these are sold only through Swiss retail investors network. Okay, so that is ALPINE convertibles. Okay, so that's all for international bond. Now let's move on to the second one, that is deposit receipt. Okay, so I have already made a full length video on deposit receipt on ADR, GDR and IDR. So if you have not seen that video, that link is also given in the description box. You can check it out. So I will just explain what is deposit receipt, what is ADR and what is GDR. For detailed explanation, please watch the video given in the description box. Okay. So what is a deposit receipt? Deposit receipts are negotiable securities which are issued outside India by a depository bank on behalf of Indian company. Okay. That is, deposit receipts are traded on stock exchanges in US, Singapore, Luxembourg, London, etc. And these deposit receipts are commonly used to raise equity finance. Okay, so we can understand what is a depository receipt with the help of an example. So this is an Indian company. So this Indian company want to sell the Indian company shares to other countries. Okay, so they can issue this shares in London Stock Exchange and in American Stock Exchange, but the Indian company cannot directly sell their or issue their shares in American or London Stock Exchange. For that, they have to issue depository receipt. Okay, so depository receipt are negotiable securities which are issued outside India by a depository bank on behalf of an Indian company. Okay, so the first one is GDR, that is Global Depository Receipt. Okay, so what is a GDR? A Global Depository Receipt is a certificate issued by a bank that represent share in a foreign stock on two or more global market. Okay, this Global Depository Receipt is negotiated and issued in all parts of the world except in United States of America. Okay, so in USA it is given as ADR, that is American Depository Receipt. In all other countries, GDR is accepted and issued. Okay, therefore a person wishing to purchase GDR can buy them on London Stock Exchange or Luxembourg Stock Exchange among other security markets in Europe. Okay, so GDR and the dividends are priced in local currency of the exchanges where the shares are traded. So if it is traded in London Stock Exchange, then the dividend will be priced in London currency. Okay. Now we can understand this GDR better with the help of this example. So this Indian company XYZ is an Indian company, and this Indian company want to issue 50 shares. Okay, wish to issue 50 shares. For that, they have to approach our global bank. Okay, this global bank should be situated both in India and suppose we are issuing this GDR in London Stock Exchange. If the Indian company want to issue their shares in London Stock Exchange, they have to choose a global bank. Okay, that bank should be situated in India as well as situated in London. Okay, so suppose this is a global bank which is situated in India. The Indian company will go to this global bank and tell them that they are interested to sell 50 shares of their company in London Stock Exchange. Okay, then the Indian company and the global bank will come to an agreement and will suppose they are agreed that 10 shares is equal to 1 GDR. Okay, 10 shares is equal to 1 GDR, and they agreed upon issuing 50 shares. Okay, so the global bank will inform the London Stock Exchange, and the London Stock Exchange will issue 5 GDR of company XYZ in London Stock Exchange. Okay, is that clear? I will explain once more. That is, there is an Indian company named XYZ, and this Indian company want to sell their shares in London Stock Exchange, okay, or issue their shares in London Stock Exchange. For that, they have to approach a global bank which is present both in India as well as in London, okay. Once they approach the global bank, they have to make an agreement upon the ratio of their shares as well as GDR, okay. Suppose they agreed upon 10 shares is equal to 1 GDR, then and if they are agreed to issue 50 shares, the company agrees with the global bank to issue 50 shares. The global bank will inform the London Stock Exchange to issue 5 GDRs, okay, and thus Indian company can raise fund from London Stock Exchange by issuing their shares. So this is by issuing GDR. This is Global Depository Receipt. I hope it's clear to you all. So next one is American Depository Receipt, that is ADR. So these are the same negotiable instrument which are issued by American banks suggesting the number of shares of a foreign company that can be traded in US stock exchange. Okay. So we can understand this also with the help of an example. So yeah, we can take this example for understanding ADR. So there is an Indian company named XYZ. Okay. So they want to issue their shares in American Stock Exchange. Okay. They want to issue their shares in American Stock Exchange. That is, they want to issue 50 shares itself. Okay. They want to share 50 shares, issue 50 shares. Okay. So for that, first the Indian company will have to connect with the American bank which is located in India. Just the same as GDR, the Indian company will have to approach the American bank which is located in India, and they will be coming to an agreement according to the ratio. That is, suppose here also it is said that 10 shares is equal to 1 ADR. Okay, 1 ADR. Suppose they come to agreement, then this American bank will inform the American bank located in America, and the American bank will issue ADR on, that is 5 ADR. They will issue 5 ADR on the 50 shares. Okay. Thus, the Indian company, XYZ Indian company, can raise fund from American Stock Exchange. Okay. So, if it is issued in London Stock Exchange or Luxembourg Stock Exchange, it is issued through GDR, that is Global Deposit Receipt. And if it is to be raised, money is to be raised or shares has to be issued in American Stock Exchange, then they issue American Deposit Receipt, that is ADR. Okay. So that's it. I hope it's clear to you all. Okay. So that is the main thing of a deposit receipt. So deposit receipt is a negotiable instrument or security which are issued outside India by a depository bank on behalf of an Indian company. And this deposit receipt is classified into two as global deposit receipt as well as American deposit receipt. Okay. Now we can see what are the advantages of GDR or ADRs. Okay, what are the advantages? So it is possible to raise equity fund in international financial market. It enhances the image of the issuing company and the country in international area. Suppose Indian company XYZ is raising fund from America or from London, it will increase the image of that XYZ company as well as our India in foreign countries. Okay. It also helps in broadens the shareholder base. It facilitates tapping of international capital flows. It is also possible to list and trade in international stock exchanges, and it is a liquid financial instrument. So ADR and GDR is a liquid financial instrument, and ADR and GDR also reduces foreign exchange risk because of denomination in US dollar or in some other freely convertible foreign currency. It provides the issuer company and the ability to raise fund at a lower cost, as well as it helps to raise capital simultaneously in two or more markets through global financing. Okay. So if a company is offering globally, they can raise capital simultaneously from two or three markets. Okay. So these are the major advantages of GDR and ADR. Okay. So now the last one is international equity. Okay, this is the last classification of international capital market. So what is an international equity? International equities or the euro equities represent neither debt nor foreign direct investment. They represent foreign portfolio equity investment. Okay. In this case, the investors get dividend and not interest. That is a very important point. In case of bond, always the interest will be paid, but in case of international equities, there will be no interest, but dividend is paid to the investors. Okay, so international equities are a compromise between debt and foreign direct investment. Okay, so international equity represent the foreign portfolio equity investment, and here the investors will be getting dividend and not interest. Okay, so yes, that's it. Today we learned about international capital market instrument, in which we learned international bond, then deposit receipt, then international equities. Okay, and we also learned the classification under international bond, that is foreign bond, euro bond, and other bonds such as global bond. Okay, so I hope it's clear to you all. And if you have any doubt, please put it in the comment section below. Okay. So if you like the video, give it a big thumbs up and also share this channel to all commerce students you know. And you can also comment down the topics you wish to ask. And if you have not subscribed yet, please subscribe to Let's Learn and click the bell icon to get the latest notification as I'm uploading a commerce video on a daily basis. Okay. So for more commerce videos, keep watching Let's Learn. Thank you.